Hey, what's up, guys? Welcome back to the channel. My name is Frank Mularcik, and this is episode 7 of my Dow Jones Industrial Average video series. And in this video, we're going to be analyzing the 6th smallest company in the Dow by market cap, and that company is Goldman Sachs, ticker symbol GS. If you find value in my videos, make sure to like and subscribe so you don't miss out on future content. This is Frank Mularcik. So first of all, just looking at our spreadsheet here, in the last video we analyzed Boeing, ticker symbol BA, so we're going to check this box here. So if you did miss that video, make sure to check that out. The next one here is Goldman Sachs, first one crossing the $100 billion market cap level. So that's pretty exciting. So that's what we're going to be talking about today. And the first thing we're going to be taking a look at is the 10K report from 2021. And for me, banks in general are pretty confusing, and I definitely don't understand everything about banks, especially more of like an investment bank like Goldman Sachs. So going over the 10K is going to be a little bit different than normal, because one of the main things I want to talk about is their actual business, how they make money, because to me that's important, since it's not as clear to me when looking at their business how exactly they make money. So I want to make sure that everyone else understands that as well. So basically they have 4 segments here in their business, which are investment banking, global markets, asset management, and consumer and wealth management. So we're going to go through all 4 of those. So the first one here is in investment banking, which serves public and private sector clients around the world. So their first method of generating revenue through investment banking is through financial advisory, which basically includes strategic advisory with respect to mergers and acquisitions, divestitures, corporate defense activities, restructurings, and spin-offs. And they assist clients in managing their asset and liability exposures and capital. And the next thing to do is underwriting, which is helping companies to raise capital and fund their businesses. So pretty straightforward there. And there's various types of underwriting through equity underwriting. So one of the main forms of this is public common stock offerings and initial public offerings, IPOs. So that's pretty exciting that they get involved in some of that kind of stuff. And then they also do debt underwriting, which they basically underwrite and originate different types of debt instruments, including investment and high yield debt, bank and bridge loans. And these are dealing with corporate, sovereign, municipal, and agency issuers. So that's their debt underwriting. And then they also do corporate lending, which basically means they lend to corporate clients. Pretty straightforward there. And that's about it for the investment banking segment. The next segment is global markets, which serves clients who buy and sell financial products, raise funding, and manage risk. So they act basically as a market maker and offer market expertise on a global basis. So essentially they're a market maker. That is sort of straightforward. There's not a ton there, but the 2 components there are within the FICC and equities. So the FICC, I had to look this up and I wrote it down so I didn't forget it. It's the Fixed Income Clearing Corporation, basically a government agency that regulates how market transactions take place, essentially. So they deal in FICC intermediation, which basically means they execute trades essentially for various clients. And these are the types of products that are traded that they execute. So interest rate products such as government bonds, credit products such as corporate securities, derivatives, ETFs, loans, municipal securities, emerging market and distressed debt, and trade claims. The next one there is mortgages, basically any type of asset-backed security, loans, or derivatives dealing with real estate. The next one is currency, also commodities. So commodity derivatives for crude oil, petroleum products, natural gas, agricultural, precious base metals, electricity, renewable power, environmental products, etc., etc. So a wide range of commodities. And then the next sort of portion of the FICC segment is in FICC financing, which basically means they provide financing to clients through warehouse loans, which includes residential and commercial mortgage loans. And then they also have corporate and consumer loans, which include auto loans and private student loans. So that's interesting. They're, kind of into the loans, consumer loans more specifically, which is pretty interesting to me. And then the next part here is in equities. So basic equity intermediation, obviously securities, options, futures, ETFs, and OTC derivatives are their basic products that they facilitate those client transactions for. And then they also deal with equities financing, which means they earn fees by providing clearing, settlement, and custodial services globally. And the next segment here is asset management. And basically, they generate revenues from fees a lot of times within asset management. So that can include management fees, which is basically asset-based fees on client assets. And then they also sometimes have incentive fees, which are based on a percentage of a fund's actual return or an account's return, or when the return reaches a specified benchmark or some sort of target. And then they also have equity investments, in which these are sort of alternative investing activities that relate to public and private equity investments in corporate real estate and infrastructure entities. And then they also have some lending and debt investments, which are investments in corporate debt and financing for real estate and other assets. So that's kind of, the asset management business. The last one here is consumer and wealth management, which is basically aimed at helping clients achieve individual financial goals. So within that, they sort of have wealth management, which serves individuals, families, family offices, foundations, and endowments. And within wealth management, they generate revenue from fees, again, similarly, asset-based fees and similar incentive fees. And, the return reaches a specified benchmark or some sort of other performance target. And then also private banking and lending, which includes net interest income allocated to deposit taking and income earned on lending activities. That's sort of the wealth management within consumer and wealth management. And then finally, consumer part of it is consumer banking. So they have the digital platform Marcus, which is kind of an online bank. And that also offers, credit cards and lending as well. And they also have investing services, which is called Marcus Invest. I think that's sort of like a brokerage account. I'm not sure if you can just buy and sell stocks directly or if they have some sort of like managed accounts for you. I'm not exactly sure how that works, but I've personally used Marcus before as sort of like a high yield savings account. It's worked well for me in the past. I kind of stopped using it few months ago probably, but it's definitely a good product and pretty easy to use. And another thing I wanted to talk about is risks. In the 10K report, they always have a section dedicated to risk factors. And one of the first risk factors they mention is the market. They basically say our businesses have been and may in the future be adversely affected by conditions in the global financial markets and broader economic conditions. And they highlight a few points here that are very relevant to today, I think. So they say our financial performance is highly dependent on the environment in which our businesses operate. A favorable business environment is generally characterized by, among other factors, high global gross domestic product growth, regulatory and market conditions that result in transparent, liquid, and efficient capital markets, low inflation, business, consumer, and investor confidence, stable geopolitical conditions, and strong business earnings. So a few of those I highlighted here, such as high global gross domestic product growth. Obviously, in 2020, there was GDP decline of about 3%, I think. And I'm not sure. I was looking for the numbers for 2021. I'm not sure if they're not out yet or what, but I couldn't really find any numbers for 2021, but at least for globally. But I would guess, if they were positive, they were not that much positive. So that could definitely be an issue. And then another one, low inflation. Obviously, we are in a fairly high inflation environment right now. Hopefully that does go down, but I don't think it's going to be within the next month or two that it just drops off a cliff. It's going to take time. Investor confidence is, that's definitely, something that's hard to measure, but generally over the past few months, the stock market has been going down and it's been pretty dramatic over the past few weeks per se. So that could indicate that there's not very much investor confidence. And then stable geopolitical conditions, obviously that's not really true right now with obviously what's going on in Russia and Ukraine and just the issues going on over there that are affecting the rest of the world as well. So those are kind of some big things that they mentioned could affect their business. And, of the maybe 5 or 7 items that they listed, about half of them are really not favorable right now, I would say. So it's definitely something to keep in mind for, banks as a whole, but also, the entire market as a whole, I would say at this point in time. So I wanted to go over the balance sheet just a little bit. Even though I don't know a ton about banks and I'm not, an expert at all. I just wanted to go through a few points that management talked about in their discussion of the balance sheet and just kind of point those out. So the first thing would be, total shareholders' equity is around $109 billion compared to $95 billion last year. And they also have a number, which I think they might list right here, which is tangible shareholders' equity. Or tangible common shareholders equity, which is only 94 billion, but that's still up from last year. And basically that's, minus goodwill and intangible assets and minus preferred stock. But the thing they pointed out here was the debt to equity ratio, which is about 2.3. And for, regular companies in most sectors of the market, that's generally a little bit high. But for a bank, that's definitely acceptable, and I think that's pretty solid, to be honest, from what I've seen, because banks generally take on more risk and more debt than other companies, because that's really how they make their money, But it is kind of crazy to look that their total assets are almost $1.5 trillion, just because they're a bank. They're a bank. They have so much on their balance sheet. Obviously, they have, over $1 trillion in liabilities too, but it's just still something that's kind of fascinating that they just have so much there, And they have about $254 billion in long-term debt, which is pretty substantial and definitely a little bit higher than last year. But it's not something I'm really too concerned about right now. And the next thing I wanted to look at was the book value, which is pretty important for a bank, or at least a metric that's used often when looking at banks. So their book value per common share is $284, which is up about $50 from last year. And their tangible book value per common share is $270, which is, again, up about $50 from last year. So that's pretty good when you look at the stock price of around $295, I think, today. That's pretty good that your book value is pretty close to that, to be honest. And the final thing I did want to look at is they talked about share repurchases a little bit. And basically they said at the end of 2020, they had around 358.8 million shares. And at the end of 2021, they had 348.9 million shares. So basically they bought back about 10 million shares in 2021, which is pretty awesome to see. And for a steady company like Goldman Sachs, a very solid company, I think that's a good trend that I hope will continue. So the next thing I'm going to look at here is the dividends. So right now they have a current dividend yield of around 2.6%. Which I think is a lot higher than it used to be just a few years ago. They've been increasing the dividend pretty quickly. You can see their 5-year average dividend growth is around 22, almost 23%, which is pretty awesome, and a super low payout ratio of around 14%. So even if they, continued increasing the dividends and their earnings over the next few years don't really keep up with that, that's still completely fine, and their payout ratio will still be very healthy. Seeking Alpha has dividend growth listed of only 5 years. And some other sites that I often use to verify that dividend growth amount, they said 1 year. Basically, those were MarketBeat and Dividend.com. They both said 1 year, but I was just looking at the numbers and that really didn't make sense. So I think the true value is 10 years based on their dividend history. I basically looked at them all and they're increasing. And the nuanced thing here is that the dividend does not have to be raised every single year for it to count as a dividend increase, as long as the total amount paid in a year is greater than the total amount paid in the prior year. That's all that matters. So as you can see, there was no raise in 2020. They paid $1.25 every single quarter, but they still paid, $6 or $5 in total in dividends in 2020 compared to the, what is that, $4.30 maybe? I hope that's right. $4.15, something like that. For some reason, I can't do that math very quickly. But the point being that they paid more in 2020 than 2019, so that's all that matters. And if you go back, they have been doing that since around 2012, I believe. See, in 2010 and 2011, they paid the same amount, but they increased in 2012. So as long as they keep paying this $2 throughout the rest of 2022, that will count for a dividend increase in 2022 as well. So that has been 10 years for them. The next thing we're going to look at is valuation a little bit. So the first metric would be PE ratio. And right now the PE ratio is 5.91, which is pretty solid. And the one thing to keep in mind is that their earnings have grown very drastically over the past few years. So, 2016, 2018 levels, they were bringing in, $10, $15, $20 of earnings per share every year. And, the past few years, they've been bringing in $40, $50, $60 of earnings per year per share. And a lot of that is definitely due to, higher inflation rates, easier borrowing of money, or I guess lower interest rates on borrowing of money, not necessarily higher inflation rates. And, obviously the stock market has been doing incredibly well the past 2 years, at least up until the past few months. So all of that stuff is contributing. So I definitely don't expect these earnings to stay as high. So, if the P ratio comes back up to, 10, 15, I think that would definitely be expected over the next few years. But even at this point today, I think it's pretty good compared to where it's been historically. And when we compare it to the financial sector as a whole, which we would expect to have performed similarly. So if, for example, banks just performed a lot better over the last 2 years, we would expect, the whole financial sector to do that. We can see the average for the whole sector is around 16, and the average for the capital markets segment, which Goldman Sachs is a part of, the average for that, industry is down here at 24. So Goldman Sachs around 6, much lower than both of those averages, which is very good to see. And finally, looking at the DCF calculation, this is a little bit interesting for a variety of reasons. The first being that they have negative discounted cash flow over the past 2 years. So in that case, it's kind of hard to predict out future free cash flows based on that. And the second thing is that management basically said they had negative free cash flows, but that doesn't really matter because the free cash flows bear little relation to our net earnings and net assets. That is a quote from management in the 10K. And so at that point, a DCF calculation really isn't that great because one of the fundamental assumptions is that you use the income to predict the free cash flow. And so you want the income and the free cash flow to be at similar levels. And if the free cash flow really has no relation to net earnings, then that's not a great company to be doing a discounted free cash flow on. But just for the heck of it, I did the calculation and I got a fair value of $800 with a buy price of $724 compared to the current price of $295. Definitely looks undervalued right now from the discounted free cash flow or discounted cash flow calculation. But again, I would not, put much faith or stock into this calculation just because of the nature of the business and some of those other factors that I mentioned. And the last thing we're going to look at is just a quick chart of Goldman Sachs stock and how it's looking. So right now, like I said, they're trading around $295, which is only about $20, $15 to $30, depending on what exact metric you look at, above their book value per share. So that's definitely a good sign for sure. But if you look at the chart, they really haven't been in this level for very much time over the past 2 years. So they were, in this 150 to maybe 220, 250 level for a few months during, the summer of 2020. And then they just have kind of gone up pretty steadily since then until, November of 2021. And then they've been dropping off pretty steadily since then. And so the problem at this point is that there's not much volume in this area, as you can see. So really, there's a lot of things that could happen from here. And I think given the current market conditions, there's definitely a good chance that it could continue falling. And if it falls even more, that just gives it more opportunity to fall because of this low volume in this range. And we can definitely look a little bit closer on the 1-year chart and see, a similar pattern, a little bit of an uptrend here at the beginning of the year, and then just been trending down since then, and really not much sign of stopping. I guess we could say that the RSI is getting to an oversold point. So, it's likely not going to be many huge red days continuing into the future, but at the same time, that doesn't mean it's going to go straight back up either. So definitely not looking the best from a technical perspective at all. But like I was saying before, Goldman Sachs is pretty solid in terms of the fact that they've been growing earnings pretty quickly over the last few years, which obviously I don't think is sustainable in the long term, but it's a good sign for sure. And they've been growing their dividend pretty quickly over the last few years as well, which is definitely a good thing as well. They don't have a super long track record of dividend growth, but it's definitely something I think they can achieve for sure. And there's definitely some risk factors associated with their business in these current kind of conditions. But, again, I don't think those are things that are going to, kill their business and make them go bankrupt. It may cause them to struggle for a few years and, not produce the absolute best results in the next few years. But in the long term, that probably won't matter that much. So for me, I'm not really interested that much in Goldman Sachs stock at this price. But, for someone that's more knowledgeable about the business, I can certainly see that they might think this is a great price, and I would not have any problem with that because, again, looking at the book value compared to the current share price, it's pretty close. The current share price is pretty close to the book value. So let me know if you do have any thoughts about Goldman Sachs stock and what you think about the current prices. I would definitely love to hear that in the comments down below. Just want to thank everyone for sticking around to the end of the video, and I'll see you in the next one.